peek at the markets today, you probably saw a whole lot of red. It was a pretty steep drop across the board, and in this explainer, we're going to break down exactly why it all happened. And yeah, that's the number that really tells the story. The Nifty 50, one of our key market benchmarks, just plummeted by 365 points. That's a sharp drop of 1.41%, with the market closing at 25,454 on February 19th, 2026. You know, a fall this big, it's rarely because of just one thing. In fact, the word getting thrown around today to describe this scene was a bloodbath. I know, it's a dramatic term, but honestly, it really captures that intense wave of selling and just the negative feeling that seemed to grip every investor out there. So, what on earth happened? What were the triggers that all came together to create this massive sell-off? Well, let's unpack it. See, it wasn't just one single event, but really a handful of different things that created a kind of perfect storm. We're going to walk through each one of them, starting with some trouble that was brewing thousands of miles away. So, first up, let's talk about the external shock. Good old geopolitical tension. It's a powerful reminder of just how interconnected our world is, and how something happening on the other side of the planet can directly impact your investments right here at home. The spark, it seems, was rising tension over in the Middle East. We started getting reports of increased military activity between the US and Iran, right in the Strait of Hormuz, which is this incredibly important choke point for the world's oil supply. Just the hint of a potential conflict there was enough to send a shiver of fear through global markets. And whenever that happens, you see this classic market reaction. It's called a flight to safety. Basically, when uncertainty spikes, investors get nervous. They start selling off assets they see as risky, like stocks, and they move that cash into things they see as safer, like gold. And that rush for the exits is what starts to drive the market down. Now, these geopolitical jitters didn't just stay in the news headlines. Nope, they created immediate economic ripples, and the first and biggest one had to do with the price of oil. The most direct consequence was an immediate and pretty scary spike in crude oil prices. With everyone fearing a conflict in a major oil region, the global price just surged past that $70 per barrel mark, and that immediately raises alarm bells about inflation. So why is this such a big deal for India? Well, here's the thing. India is one of the world's biggest importers of oil. So when crude prices go up, it means higher costs for, well, pretty much everything, from transportation to manufacturing. That can really squeeze company profits and acts like a brake on the whole economy. And at the same time, we got another piece of global news that was kind of souring the mood. The minutes from the U.S. Federal Reserve's latest meeting came out, and they showed that officials were actually a bit divided on when to cut interest rates. You know, any little hint that rate cuts might be delayed tends to worry global investors, because it means the cost of borrowing money could stay high for longer. Okay, so those were the big global triggers. But what was happening right here, inside the Indian market itself? Let's shift our focus to the domestic side of things and the market's own psychology. A key phrase you probably heard a lot today was profit booking. It sounds technical, but it's a super simple idea. When a stock or the whole market has gone up for a while, people start to sell to lock in those gains. It's a totally natural part of how markets work. And that is exactly what happened. The market had just come off a nice little 3-day rally, pushing the numbers up. So when all this global uncertainty suddenly hit, and with no fresh positive news coming from inside India, a lot of investors just decided, you know what, this is a good time to cash in. And that added a ton of selling pressure. And listen, this wasn't just a problem in one little corner of the market. The selling was broad-based. It hit all the major sectors that really drive our economy. We're talking banking, auto, realty, consumer goods, you name it. That just shows you how widespread the negative feeling really was. And within those sectors, it was the big guys, the heavyweights, that took a really hard hit. Stocks like Reliance, HDFC Bank, and ICICI Bank, these companies have so much influence on the Nifty 50 index that when they fall, they have this massive outsized pull on the entire market. Their decline today was a huge reason for that big 365-point drop. So when you pull all these different threads together, you can really start to see the full picture of why the market took such a tumble today. What it all boils down to is that today was a perfect storm. It kicked off with geopolitical fear from the Middle East, which led directly to that economic shock in oil prices. That was then piled on top of by the policy uncertainty coming out of the U.S. Fed. And back home,
All this bad news gave investors the perfect excuse to book their profits after that recent rally, which then sparked this massive, widespread selling across all the key sectors.
Ultimately, a day like today really shows just how interconnected everything is. Understanding these drivers is crucial, and it leaves us with that big question every single investor has to ask themselves. When you see a sea of red like this, is it a warning sign to run, or is it an opportunity in disguise? Thanks for joining this explainer.